Brent crude is above $111 a barrel. The Strait of Hormuz is under a closure threat for the first time in years. And the two largest UK oil majors are sitting inside the same geopolitical storm, but not in the same position. Shell is buying back shares this week. BP's net profit margin is sitting at 0.03%. That is not a typo. The surface reading says this is a straightforward energy windfall moment. Oil up, producers up. Hold your positions. That reading misses the structural fault line running directly between these two companies, and understanding that fault line changes how the current oil spike should be interpreted. The Strait of Hormuz handles roughly 20% of global seaborne oil flow. A sustained closure would be among the most disruptive supply events in modern energy history. Iran conflict coverage dominated UK financial media this week, with over 300 mentions. That volume alone signals how seriously institutional desks are treating the risk. Brent crossing $111 is not just a price point, it is a margin inflection threshold for integrated oil companies. At that level, upstream production economics improve sharply, but so do downstream input costs, particularly for refining and jet fuel. Shell's CEO explicitly flagged a Europe fuel squeeze and a jet fuel hit, in the same breath as reporting that trading operations would deliver materially higher results. Those are not contradictory statements. They describe two different business lines inside the same company responding differently to the same shock. That split, upstream and trading benefit, downstream suffers, is the structural dynamic that most coverage is collapsing into a single bullish headline. Iraq oil exports resumed after the strait briefly reopened. US shale drillers are already signaling output increases on the price rally. Both of those are supply-side pressure release valves. If either scales fast enough, the $111 level becomes a ceiling rather than a floor. Here is what most of the bullish framing on Shell is quietly stepping around. Shell's market beta is 0.10. That is statistically close to zero correlation with broader market moves. In a high volatility geopolitical environment, that looks like a safe harbor. But it also means the stock has historically not captured oil price spikes the way a pure upstream producer would. Shell near its 52-week high of $94.90, while simultaneously missing Q4 earnings. Revenue came in at $64.09 billion against expectations of $65.82 billion, is a market that is pricing geopolitical optionality, not recent fundamental performance. Morgan Stanley downgraded Shell to equal weight in late March. Rothschild and County Redburn moved it to hold from strong buy. Those downgrades landed before the Hormuz escalation fully priced in. The tension is this. The stock is being re-rated upward by Piper Sandler to $106 and Wells Fargo to $94 at the exact moment that operational earnings missed. The bull case rests entirely on Shell's trading division, which is volatile by nature, sustaining materially higher results for long enough to justify the valuation step-up. Shell's debt-to-equity ratio of 0.38 gives it the balance sheet runway to absorb a reversal if trading normalizes. That low leverage is a genuine structural advantage. But it does not make the trading windfall recurring. BP's situation carries a different kind of risk and a different kind of optionality. A net margin of 0.03% at current oil prices is a structural signal, not a temporary one. The company's debt-to-equity stands at 0.74, nearly double Shell's. That leverage profile matters acutely if oil prices retreat and credit conditions tighten simultaneously. The analyst community is visibly divided. Morgan Stanley upgraded BP to overweight. Zacks and Scotiabank both moved it to strong buy. Melius Research went the opposite direction with a sell rating and a $31 target, against a stock trading near its 52-week high of $48.27. That spread between $31 and $54, which is Wells Fargo's new target, is not normal analyst disagreement. It reflects genuine uncertainty about whether BP's current earnings power can sustain the stock at current levels once geopolitical premium fades. BP's dividend yield at 4.4% is meaningful in a high-rate environment, but only if the balance sheet can support it. LGIM's announced intention to vote against BP's chair at the AGM adds a governance overhang that is separate from, but compounding with, the financial vulnerabilities. BP's one-year low was $25.79. The distance between that floor and today's price near $48 represents a significant recovery that has been driven partly by oil prices and partly by strategic pivot expectations. If Hormuz risk de-escalates faster than the market currently prices, which is plausible given Iraq's export resumption and US shale response, BP's leverage amplifies the downside move more than Shell's does. The upside path for BP exists, but it is conditional on oil staying elevated long enough for improved earnings to flow through to the income statement. RBC's expectation that oil majors gain from LNG price dislocations is directly applicable to BP's asset mix. A sustained LNG repricing event, separate from the Hormuz spot price spike, could re-establish BP's earnings trajectory on more durable footing. The scenario that matters most is not full Hormuz closure. That is the tail risk. The base case is prolonged uncertainty, partial disruption, elevated insurance premiums for tanker routes, sustained volatility without a definitive resolution. In that environment, Shell's trading desk is structurally better positioned than almost any other business line in either company. Volatility is the input. Trading margin is the output. Evidence leans toward Shell maintaining its trading advantage through the uncertainty window, but only if Middle East volatility remains elevated and does not resolve quickly. The share buyback program running this week is a management signal that the balance sheet is comfortable at current levels. A 0.38 debt-to-equity ratio with $111 oil provides that confidence. For BP, the path that restores conviction is not the same as Shell's. It runs through governance stabilization, balance sheet reduction, and a sustained oil price above a threshold that actually prints meaningful net margins. The 0.03% net margin figure at $111 oil suggests the cost structure needs addressing regardless of where Brent trades. The asymmetry in this situation is counterintuitive. Shell, the stronger balance sheet with the active buyback, is also the company whose near-term upside is most dependent on a volatile and inherently temporary trading windfall. BP, under heavier debt and governance pressure, carries more downside risk, but also more recovery torque, if structural improvements land while oil stays elevated. Neither story resolves cleanly. The Hormuz risk is the forcing variable, and it remains unresolved.